Good evening and welcome to the 15th Annual Pershing Square Challenge. My name is Meredith Trevetti and I'm the Managing Director of the Halbrand Center for Graham and Dodd Investing. We are thrilled to be hosting this event in person and to welcome you all to our new home in Manhattanville. The vision for this space when it was created was to be a hub for the bridge of theory and practice, which is exactly what Bill provides in supporting this incredible class and challenge for now 15 years. Thank you to Julia Kimiagar for her work throughout the semester, coordinating the class mentors and fund visits, and so beautifully executing tonight's event. Thank you to Michael Herman, Damian Krieber, Lauren Harmon, Brian Waterhouse, and Evan Zainel for teaching the Applied Security Analysis class and getting the students to this point. All of the professors participated in the challenge when they were students and have gone on to have successful investing careers of their own. Each is a testament to the strength of the Columbia Business School network. Thank you so much to Bill, whose support has impacted thousands of lives at Columbia Business School. We counted up the number of students who have taken applied security analysis since inception, and it's over 1,050 students who have been impacted by this class and Bill's generosity. We are so grateful for all that you do. And with that, I'm going to turn it over to Michael Herman.
Please. Thank you, Meredith. Good evening. Thank you all for joining us for the 15th Annual Pershing Square Challenge. And I think, as everyone in this room knows, the Pershing Square Challenge is the culmination of a class called Applied Security Analysis here at the Business School, or ASA, as we call it, which is a class of approximately 70 students who work on in teams of 3 on stock pitches throughout the semester. We had over 20 very strong pitches this year, 5 of which were selected by Pershing to pitch to you tonight in the finals. The 5 finalists in alphabetical order are Car Gurus, Games Workshop, PayPal, Progeny, and Tandem Diabetes. So just quickly on the format, as I think most of you know, 10 minutes of pitching followed by 10 minutes of Q&A from our judges. And then once all 5 teams have gone, the judges will break for a short deliberation, come back and announce the winner or the winners. There's a few people we'd like to thank just real quick for their efforts that have helped make the course a success. First, I'd personally like to thank my co-professors, 3 of which are here with us tonight, in alphabetical order: Brian, Damian, Evan, and Lauren. The 5 of us would like to thank Tano, Meredith, and Julia of the Halbrand Center, who have been vital to making the class a success. Our 2 wonderful TAs, David Winslow and Shalan Doshi. All the funds and the mentors who have helped the students over the semester develop their pitch. Tegas, who provided access to all the students to their transcripts and gave each team 3 custom calls to speak with industry experts, which was hugely helpful for their research, and for the judges for joining us tonight, for taking the time. Finally, we would all like to thank Bill and Pershing. As we've said, this is the 15th year, so we've been sponsoring it for 15 years, and the 5 co-professors all competed in this competition many, many years ago, and we all agree that it was very formative in our development as investors. We hope it was for the students this year, and we hope it will be for students in the years to come. So the Pershing Square Challenge, as I'm sure Bill will talk about, was started with 2 main objectives. First was to develop the next generation of value investors, or as Bill likes to say, the next generation of his competition. But second, and just as importantly, for students to learn about philanthropy, start thinking about philanthropic causes. So traditionally, the winning team or teams donate a portion of their winnings to a charity of their choosing. So on behalf of Columbia and Halbrand, thank you, Bill and Pershing, for your support, for your time, for your mentorship throughout this program, and for providing a real-life example on the importance of philanthropy. And with that, I'll pass it over to Bill to kick things off.
So thank you, Michael. And first, I want to thank the faculty for the program. I didn't actually know that all of the faculty were in the program to begin with, so there's a bit of a cycle of life element. Wonderful that you get the chance to pay it forward and return the favor for the next generation. So just a little bit about the origin of this. So first of all, I'm not a Columbia Business School graduate. I'm a Harvard Business School graduate, and I always like to tell the story. Look, I'll make the case for Columbia Business School, which is why we're here. But my first meaningful investment mistake, and it was meaningful, was I went to Harvard Business School to learn how to be an investor. And it was at the time $40,000 a year plus housing. And I sent in my tuition, which, by the way, my parents paid for me, but they didn't pay my expenses when I got there, so I had an investment of my own. But I was very fortunate in that regard. But I show up, and we go and pick up the course catalog. And for those of you not familiar with what a course catalog is, this thick book, looked like a phone book, had all the courses in it. And I went back to the dorm room to go check out, put together my investing program, see what classes they had. And there was not one class on investing at Harvard Business School. There were classes about accounting, competitive strategy, human resources, but not one on investing. And so the first lesson I learned about investing was you're supposed to do your due diligence before you send in the money. So I thought that was, so I learned at Harvard Business School. But the reason why this program is at Columbia is an old and wonderful friend of mine, Paul Halal, I went to college with, is a CBS graduate, and Paul was at Pershing for probably a decade. And we sort of came up with this idea together, and he said, let's do it at Columbia. And that geographically made a lot of sense, and it actually made a lot of sense because you guys actually had a real value investing program, so it made a lot of sense. And what I can say is, I would say every year, the quality of this contest has gotten better and better, and I think that's parallels really the growth and success of the Columbia Business School. So you are at a absolutely top institution, as I'm sure you know, and a great place to learn the trade of investing and value investing. The philanthropic genesis of this class was the idea was if you're going to choose this industry and you're successful, this is a business where we get overpaid, you end up with more money than you need, and then how to decide what to do with those resources, and hopefully philanthropy plays a role there. And by the way, we always test this each year, and everyone's free to do what they want, which is there's going to be $150,000 of prizes. We get to decide after we hear all the submissions how they're going to be allocated. We've given typically the first, second, and third prize share in the resources. I think we have on occasion just awarded the number 1 and number 2. We could do 1, 2, 3, and 4. That's really up to the judge's sort of ultimate discretion. And then the funds are yours. You can keep them all if you win, or you can choose to give some or all to philanthropy. And the philanthropy has to be a Columbia University-related event. So I think it's easy to give money away when it's not yours. It's harder when it's yours, so it's yours, okay? And then you get to decide, what you want to do with it. And I think that in itself, there's a learning associated with that. And lastly, I want to just thank Meredith and the Heilbronn team and Columbia for really doing a great job with this class and program. And it's a really nice, successful thing, and a lot of successful people have come out of this program. Let me take a moment to introduce the judges. We decided to overweight the panel with Pershing Square investment team members this year, just for fun, as a change of pace. So I'll start with the Pershing Square members. I'll start on the left here is Ryan Israel. Ryan went to Wharton, a competing business school, and he's been at Pershing for 13 years. Anthony Massaro, also from Pershing. And Anthony's probably been 9 or 10 years? Yeah. Almost 9 years. And he also, I think, went to Wharton, didn't he? Just a little bit. Why do we have more Columbia Business School people? I don't know. And then Manning, who's new at Pershing. Manning started in September. And did she also go to Wharton Business School? Undergrad. There's a bit of a cabal. Actually, a lot of people at Pershing are so much of a rush, they don't go to graduate school. They're just like, okay, I want to be a hedge fund manager at age 8. And they're like, what's the fastest path to get there? And they're like, oh, this Wharton thing, they got an undergraduate program. So that we do have a lot of Wharton people. Next, Whitney Tilson. Whitney, I've known a long time. Actually, we went to college together. Whitney is one of the great, among other things, teachers, and he's taught a lot of people about investing. He now runs a research company that does investment-related research. Had spent a number of years, probably a decade or more, 18 years in the hedge fund business. Jillian, a returning judge. She's launched your own firm on what date? Just about to, and you have how much money circled? $260 million, new launch. So we're trying to give you a good perspective on people at different stages of their career. Prior to launching your own firm, you spent your last whatever number of years. Okay, great. And then Janice, last but not least, why don't you, she's at Third Point. Janice at Third Point, and you've been at Third Point for how long? 4 years at Third Point, several years before private equity. So good, I think, diverse panel, lots of different experiences, different stages. So let's start it off. All right, first is car gurus. So we're going to judge based on a number of factors. Ultimately, we want to pick the best investment idea. Quality of presentation sort of matters. Quality of the research, it's a kind of a holistic thing. At the end of the day, that gets you to win is an idea that we think we want to put capital in. Test.
Where's the clicker? Click the what?
Good evening, distinguished judges, professors, and guests of the Halbrand Center. My name is Justin, alongside my colleagues Ed and Willie. And tonight we are presenting a long recommendation on Car Gurus, a leading online automotive marketplace for users to buy and sell cars, supported by best-in-class data analytics. Currently trading at $35 on a forward revenue multiple of 2 times, and a forward EBITDA multiple of 15 times, our analysis indicates an achievable 5-year IRR of 25% under our base case. This investment opportunity combines downside protection from stable subscription revenues with upside potential and a call option on transformative growth through the recent car offer acquisition, which provides access to new products, new customers, and new markets.
Our investment thesis is 6-fold. Number 1, Car Gurus has the clear dominance as the largest online automotive marketplace in the United States by site visits, lead generation, and inventory. Number 2, Car Gurus benefits from its powerful network effects, with engaged consumers and sticky dealers creating a formidable business moat. And number 3, we're confident that the stock is undervalued with acceptable margin of safety. Our variant view is that Car Offer has transformed the business to the extent not fully appreciated by investors. And number 4, with Car Offer, Car Gurus is unlocking 2 new potential total addressable markets, a $12 billion dealer-to-dealer segment and a $25 billion consumer-to-dealer segment, dwarfing the size of the listing TAM at $3 billion. And number 5, the business is moving down the funnel to enable dealers to compete with the CarMaxes and the Carvanas. We favor Car Gurus because it owns the customer and the bottom of funnel data versus the other top of the funnel advertising models. Number 6, Car Gurus has a high-quality financial profile with a good track record of growing recurring revenues even with supply chain and inventory issues.
Since 2005, Car Gurus has established a market leadership positions. It attracts over 39 million unique visitors to its website each month. Car Gurus' online traffic levels are superior to its key competitors, such as TrueCar and Cars.com, by significant margins. The company also has an installed base of over 30,000 dealers who pay recurring revenue under a subscription model, twice of the size of TrueCar's paying dealer. In addition, CarGuru has consistently large investment in brand equity. In the past 5 years, on average, it spends 35% more on sales and marketing than its next highest competitor, Cars.com. CarGuru has built a strong business model through powerful network effect. On one side, consumers receive greater choice given the high volume of dealer listing. It is 3 times more likely to be the final site visited by users prior to purchasing. On the other side, dealers benefit from cost-effective distribution channel to acquire or sell inventory. In doing our primary research, dealers told us they pay $2,500 per month for CarGurus. With the industry average dealer per car profit at $2,000, it only takes selling 2 cars to break even CarGurus subscription. On average, CarGurus provides dealers with ROIC in the range of 2.5 to 5 times, which is 2 to 3 times higher than its competitors.
Our returns analysis indicates an achievable 5-year IRR of 25% under our base case, based on a forward EBITDA multiple of 12 times. Alternative investment cases produce investment returns of 12% under our bear case and 34% under our bull case, based on sensitized unit drivers and flex valuation multiples. We have also performed a sum of the parts analysis that adopts market multiples for the most comparable competitors in each operating segment, namely Cars.com for the marketplace and ACV Auctions for wholesale and product. This combined valuation produces a share price of $58, which represents a healthy premium of 64% upside to the current trading price. Through CarOffer, the business also receives a call option on transformative growth by entering new addressable markets. Firstly, the wholesale dealer-to-dealer marketplace, which allows dealers to transact inventory between each other. And secondly, the product IMCO division, which allows consumers to sell to dealers under an online auction format. We believe the growth potential and vast scale of these 2 new addressable markets are not properly understood nor appropriately valued by investors. They represent enormous scale, dwarfing the size of the legacy listings marketplace TAM of $3 billion. Wholesale is 4 times that scale at $12 billion, and IMCO product is even larger, sized at $25 billion.
With that enormous opportunity, our variant view is that the market underappreciates the transformative impact of CarOffer and its effect on earnings growth. When I sold my very first car this year, I went to a few local dealers. A franchise Hendrick Lexus dealer gave me an offer of $14,000. I got an offer of $15,000 from CarMax. In contrast, I received a $16,000 and $500 from a nearby dealer through CarGurus. Being the second largest transaction in an American household, as a consumer, it was clear to me that CarGurus had the best offer with a transparent, easy process. The business is now propelled down the funnels, from initially researching customers like me to completely close the transaction. This repositions the business from a marketplace listing towards an e-commerce platform. And in that integrated platform, we see revenue drivers spurring growth across all divisions. In marketplace, it continues to provide a strong foundation for revenue. Subscription revenue per dealer grew at a 4-year CAGR of 17%. And in wholesale, in less than 1 year, over 10,000 dealers signed up on the platform, including the nation's largest auto dealers like AutoNation, Lithia Motors, exceeding the management's guidance and consensus. in product. The largest auto dealer in America, CarMax, acquired almost half of their inventory from consumers, which is unavailable to this country's almost 140,000 used auto dealers. Let that sink in. Small dealers cannot do this. Enter CarGurus, which already has covered 80% of the US population and 93% of the dealers. Car offers wholesale solution when combined with its consumer site is innovative and will be very difficult to replicate in full. Car offer is frankly totally transformative for CarGurus.
These revenue drivers produce a business mix that generates high margin, sticky recurring revenue through the core marketplace division as a strong foundation. Then the proceeds are reinvested to the new wholesale and product market penetration, funding the next phase of growth as the co-option. Ultimately, we forecast top-line EPS above consensus estimates on account of stronger than expected dealer enrollment and user conversions. Risks to our investment thesis include potential changes to Google's algorithm, dealership consolidation, and new ESG initiative. While this threat could impact future performance, we take comfort from several factors. First, CarGurus expansion down to the sales funnel reduce dependence on lead generation business. Second, CarGurus has recently navigated stress tests in the pandemic and the chip shortages. Third, even if private car ownership declines in the future, the marketplace still remains highly fragmented.
Just a brief addition to the judging panel. I wanted to just introduce Fran McGill. Fran is head of communications at Pershing Square. In that presentation quality is an important element. We're going to add him to the judging panel. So Fran, just identify yourself. Okay, great. Who would like to ask the first question?
Great presentation. I'm not biased, but we are positive on CarGurus. The one question I had actually was on Carvana. So Carvana, we believe, is a bankruptcy candidate, but obviously in the recent days, company, I think it's Apollo, has put in 1.6 billion to back Carvana. So if there's this incremental capital coming into the competition, how do you think they're going to react, and how does that put pressure on CarGurus?
I think when we were looking at this opportunity, we were mindful of this Carvana threat as a disintermediary. Our personal view, having done our research, is predictions for the demise of the dealership model have been around as long as time itself, and they've been proven wrong time and time itself again. How we got comfortable looking at our business model relative to Carvana predominantly concerns the fact that we have a take rate model. Carvana runs inventory risk, which requires a substantial amount of capital to go and buy vehicles, put them on balance sheet, very capital intensive, very working capital intensive, and then find buyers for those vehicles, running the risk that they might not be able to sell them on at a liquid, fair market price. We don't have any of that risk at all at CarGurus. We have a take rate model where we have a digital marketplace that connects buyers and sellers, and in the event that a transaction takes place, we have a buyer fee and a seller fee. We're also, to some extent, quite price agnostic, because these buyer fees and seller fees are flat fixed fees as well. They've just increased from $275 to $325 on both sides of the ledger, which simply indicates that we have pricing power, and that pricing power comes back to the network effects, because we have more eyeballs on our platform, and we have a larger number of dealers on our platform as well.
In slide 20 of the competition reposition, the one before, in Carvana's most matured market, Atlanta, Georgia, it only has 1.5% of its market share. And when we spoke to dealers, it's not a zero-sum game. Because the market is so highly fragmented, dealers have the choice of having multiple platforms on their subscription model or acquiring new inventory. But what distinguishes CarGurus from Carvana is CarGurus is an asset-light, high-margin, high-quality business of which Carvana is still unprofitable and runs high expenses on its inventory reconditioning facilities, which will be very difficult to weather an economic downturn or recession.
And the final note is probably worth flagging that Carvana is a customer. So Carvana uses CarGurus to generate that inventory because it's so desperate for that channel to bring in stock. And that's also the reason why they've recently acquired Odessa, the physical marketplace platform, to try and solve that issue that we don't necessarily have ourselves.
Thank you. I guess just one question I had was, I think in the beginning of the presentation, you talked about the marketplace business, its subscription-like characteristics, how it's about 2/3 of revenue. But when I look at your financial projections, it looks like basically that is going to be quite a minority of the business over the next 5 years due to the marketplace business growing at a reasonable rate, but really just the wholesale acquisition or the wholesale and the product business becoming much, much larger parts. When I sort of think about that business, while it is capital light, it seems to be very much based upon transactions. And given kind of where the used car market is and sort of the pricing dynamics that are exhibiting because of the shortages and where we are in terms of the sales, could you talk about how you think about this business in the context of its cyclicality? Because it does seem like in your revenue projections, you sort of show this as a very steady, quick-growing business. But the reality is, it seems like, to me, it's becoming a very different business than what it's been historically, and that may have substantial cyclical fluctuations.
Yeah, definitely acknowledging the fact that car sales are tied to the economic cycles of the business as a consumer good. However, since 2008, the most recent recession, an average dealer makes money through service, F&I, finance and insurance, and sales. And the dealer's gross profit is concentrated in service. Even in its economic downturn, the average miles driven were not changed. So people were still getting their cars serviced through their local dealers. And the dealers have way less risk compared to earlier cycles in terms of the new car sales decline. So I think CarGurus, yes, there is an execution risk of making sure that these two new platforms are able to be leveraged to a greater degree of success for the dealers and the consumers. But what essentially the story here is, we have a downside protection for the marketplace listing business and the two car options through D2D and consumer to dealer, which allows the dealers to compete in the same playing field with the Carvanas and the CarMaxes.
So just to make sure I understand the business model, if for whatever reason used car prices came down significantly or overall sales and transactions of used cars came down significantly, would the revenue associated with the product and wholesale business, given that it's a take rate business, also fall precipitously?
So the wholesale business would not be affected by fluctuations in the price of the vehicles because all of the fees that make up the unit economics, which I think are on slide 24, are fixed rate. Where it would impact is on the product side of the business because there's a margin spread outlined there in the bottom right, which is sold as a percentage of the vehicle price. So that would be affected by fluctuations. The others are predominantly affected by transaction volume. So any reductions in transaction volume for used car sales going through this platform would affect our financials. But taking cyclicality to your point, the business performed very well in the COVID environment. Dealers are becoming more acute for the wholesale and product channels specifically about how this solves their inventory needs. So even though used cars are flying off the lot and have been in this frothy environment given the chip shortages, what they've found is it's actually providing a very helpful channel for them to acquire inventory, and transaction volumes have consistently exceeded management's projections in this remark.
Can you talk to the one of the risks that you highlight, which is the Google search algorithms? You know, it's quite hard to research that, or so perhaps if you can talk to sort of how you go about researching that. You know, it's decimated areas like ad tech. You know, criteria was crushed just because of Google's algorithm change, but that was driven by sort of privacy rules changing. So I wonder what would drive the change in the algorithms, and if you can quantify the impact.
Yeah, sure. So I think the potential changes might be Google might want to come into a marketplace given they have so much search engine power and then to get into this business. However, we did take comfort from being CarGurus car offer acquisition down to the sales funnel to get transaction fulfillment. So we are not just relying on the marketplace revenue anymore. Now we have diversified our revenue streams.
You go to the competition page. So can you just talk about the relative trajectory of each of these companies in terms of market share? Is is CarGurus taking market share relative to the competition, or is someone else on a growing more quickly than CarGurus? How do you kind of lay out the competitive? What is the trajectory of the competition? Is CarGurus moving further and further ahead, or are they neck and neck with, Cars.com, AutoTrader? What are we seeing in the competitive landscape?
I think back to the brand equity slide, we had the charts. There's 4 main metrics. One is monthly unique visitors, one is traffic, one is the number of dealers on their platform, and the other is the revenue per dealer.
So if we just look at monthly unique visitors, it says 9.8% 4-year CAGR, but when I look at the chart, it looks basically flat.
Yeah, so we did not include the 4Q17, which was 24 million in there because of formatting issues. But the 4-year CAGR from 24 was a 9% CAGR.
Okay, but that looks to me like picking a low data point and comparing it to, if I look at that chart, it looks, I would say at best it looks flat. It looks like it's declining. So on monthly uniques, and then if you go to traffic, it says 8.3% 4-year CAGR, but it looks to me like, by my math, that looks flat or at best, also sort of declining. So, so what am I missing?
CarGurus became public in 2017. This is the earliest data that we could possibly get compared to its competitors. So there was no getting an earlier data point in terms of its low ball. But 4Q17, when we checked last night, was actually after submitted the deck.
Forget that date. If we just look at the chart, this doesn't look like a business. 8.3% compounded for 4 years, right? It should be up 40%, right? So 40% would mean your starting point is 90,000. We should be at 135,000 now, but we're still at 90,000 on, for example, traffic.
CarGurus, the main competitive advantage for CarGurus is its dominance in SEM, and that's how they have widened or maintained the gap between its next closest competitor. It spends twice the sales and marketing expense on the next competitor, and wherever you are in America, whatever car model you search, CarGurus is going to top the listings, and that's why that they have maintained this gap. Now, so apologies for the graph to be readjusted for the.
Yeah, I think there's an important point to note, and it goes back to the search engine capability. In terms of lead generation, the metrics you're seeing here, it's crucially important that these businesses invest in sales and marketing for digital customer acquisition. Cars.com used to be the dominant marketplace in this environment. Their key mistake years ago was pulling back on that spend to preserve the bottom line. What happened? CarGurus came in and ate their lunch. And we spend more than the second and third largest competitors in this space in Cars.com and TrueCar by a considerable margin. In fact, I think it's the amount of those two competitors combined.
But let me, again, be the difficult guy. So take a look at traffic, right? What you care about is how close the blue line comes to the red line. Looks to me like the gap is narrowing, right? It looks like Cars.com has been sort of steadily increasing. They started at 39,000. Looks like they're, by your graph, something like 45,000. So they're up, whereas the other one has been declining over the last sort of 3 years. So it looks like they're coming closer and closer despite the much higher spend. How do you think about that?
Yep, so the analysis we did when benchmarking this is Cars.com are normalizing their sales and marketing spend to a level that Card currently have. Whereas historically, they've been underinvested in this space, which is why you see that bridge narrowing and the gap between Card and Cars.com.
I mean, it's even more dramatic if you compare, first quarter of 19 with the last quarter of last year in terms of the gap between CarGuru and Cars.com. Anyway, I think we're out of time. All right, thank you very much. Excellent presentation.
Chris, wanna can you
Possible for the old-fashioned
Okay,
to
wait.
have a pen and a notepad to take notes.
test. 就这样看 ，OK。View full screen.
Right. So hi everyone. Today we are pitching Games Workshop Group, or GAW, listed in London. We think there is a compelling long investment, providing a 20% 5-year IRR on very conservative assumptions. Games Workshop Group has two main businesses. First, the legacy business, which sells tabletop gaming miniatures, primarily under the Warhammer brand. And secondly, the IP business, which licenses out Warhammer's Deep Lore.
Hello?
We think this opportunity exists because Warhammer and GAW has been mischaracterized as a legacy toy business, when in fact it sells an expensive, sticky lifestyle hobby akin to golf or photography, but without the corresponding competition. This is backed by steadily growing revenues, powered by a dedicated customer base. Its IP arm is also overlooked, having recently achieved a 23% CAGR over 5 years. It provides a virtually costless recurring revenue stream. A recent 25% year-to-date fall in GAW share price due to macro and geopolitical uncertainties provides a great entry point for a long-term investor. On conservative valuation inputs that provide a margin of safety, including A, slower top-line growth than in recent years, B, minimal margin expansion, and C, no multiple expansion, we arrive at a 20% 5-year IRR on a sum of the parts valuation approach. The legacy business is valued on a mix of PE and EV/EBITDA multiple approaches, while the IP business is valued on a DCF approach.
Actually,
This
I
slide
apologize for
explains-
maybe I should say this to all groups. Be very, very helpful to the judges who are less close to each of the companies than you are, for you just to give a 1-minute summary of what they actually do.
This is coming out right now, actually.
Okay.
So if you turn up to slide 7, this slide is actually the most important slide.
Slowly, so we understand.
Yeah.
Okay.
So it explains why this business is simple, predictable, and free cash flow generating. So the core of GAW's business is they sell this. This is what eventually becomes the sort of miniatures that we handed out earlier, right? And this costs about $65. The raw material cost to the company is at best a few dollars each, which means that this is sold at a tremendous raw markup. GAW is manufacturing this for pennies on the dollar, which tells you a lot really about the supply and demand side dynamics of the company. The question that this entire presentation answers is how. How is it possible that GAW can sell this for $65? And the short answer is that GAW's miniatures are unmatched in quality, physically, lore-wise, and community-wise. Loyal customers of the Warhammer cult following keep coming back for more to assemble, paint, and play. A flavor of the Warhammer experience has already been handed to the judges. Just for the benefit for the audience, this is something like what it looks like, right? It's really tiny. Miniatures that are slightly bigger than this sell for about $65. An example of the final product after painting as well as assembling after 10 to 20 hours of work is on the slide. So those are unpainted as yet, just so that you can get a process and a view of what the process looks like. Consequently, the average Warhammer hobbyist spends about $400 annually on the products. They're attracted to the company through teenage peer enthusiasm, the same sort of enthusiasm that a lot of teenage boys have for cool space robots with cool space guns. GAW hooks them in with strategic, cheaper beginner entry sets as an accessible hook, and they stay often way into middle age. And it is these customers that have the purchasing power to drop hundreds of dollars a year on GAW miniatures. It is fair to say that they don't just sell this. They're selling an expensive lifestyle hobby here. Consequently, we have 4 parts to our investment thesis. First, on sustainable growth. Second, on customer brand loyalty. Third, on operating leverage. And finally, on the growth of its IP arm. Chris.
So our projected 12% revenue growth is covered by the board game industry expansion alone. Despite rapid expanding market share, we use a zero market capture projection just to be conservative. Even if industry growth is slower than expected, our growth estimate will still be sustainable. And reasons for accelerated addressable market growth. Firstly, COVID customer acquisition boost accelerated community network effects, meaning customer retention even at endemic stage. Secondly, there is secular trend for board game popularity, and reasons are outlined in the slide. So we are confident that Games Workshop can minimally match this, proven by their strong track record. The core of their success is its significant customer brand loyalty. Their smart customer acquisition and retention strategy help establish a sticky hobbyist lifestyle for its customer. With great product quality, limitless backstory, ecosystem uniqueness, and distribution power, the company creates a strong demand-side moat. With its content, customizability, and community, provide a distinct value proposition, drawing fans in deep and raising customer switching cost as they spend significant time and money in their collections. The company then monetizes it with constantly refreshed through expansions. Fan spending growth drives the company's revenue growth, showing fans keep coming back for more. The new management since 2015 also played an essential role in their success. They implemented strategy to better involve community and expand fan base. Moreover, with Games Workshop consistently high gross margin, that shows a price insensitivity of their core customer base. The company also has an attractive supply side situation, as most of their costs are semi-fixed and variable costs are low, creating an attractive capital efficiency and operating leverage. Recent variable cost reduction initiatives further strengthening the company's profitability. I think this slide, I don't need further explanation. These numbers speak for itself. The company's growth has fallen straight from the top line to the bottom.
Right, and the last part of our thesis is the cherry on top of the very successful legacy business is the IP monetization. So first, we want to say why is the call option instead of a venture? Because there's no upfront cost, and they operate in this royalty-based business where they share the profit with the third-party developers and the movie producers. So you may ask, that sounds too good to be true, right? Like we're just swindling you with this call option. But this is actually the result of 40 years of investment in this IP that's not capitalized on the balance sheet. And to quantify the depth of this IP, we have this comparison with Transformers, and you can easily see how under-monetized this IP is compared to Transformers. And the second question you may have is, this company has been around for 40 years. Why hasn't it been doing this before? Well, this actually changed in 2015. Before that, they used IP as a marketing tool to sell more miniatures, and they engaged very little with the fan economy. To be honest, I learned about this hobby on YouTube instead of directly from this company. But in 2015, this all changed when Total War Warhammer became a huge success, sold for 3 million, 4 million copies. And the new management realized the monetization potentials from this IP, and they took these actions as shown here. And the main result is to change this from a niche hobby that none of you have heard of to a global IP like Transformers. So this brings us to the valuation. And our 20% IRR is based on a very conservative valuation assumptions, no market share capture, and minimal margin expansion. And you can see the 15% IRR is the safety net. I believe the judges will be very comfortable with. So our assumption is 5% retail price growth. How do we get that? We went back to 2003 and we found the price online, unit price online, and we compared it with the 2021, and the CAGR was 7.7%. So the 5% growth is a conservative measure. 2% point growth is basically engagement, how many more they will buy every year. And the 5% customer base growth is based on bottom-up fundamental analysis and primary research. Keep in mind, they only have about 1 million customers, so 5% is very small for a very small customer base. With margin expansion explained by my teammate, we have a 15% legacy IRR just on the legacy business. And now we go to the riskier IP business. The bear case is a status quo with 0% growth, and the bull case is basically historical 5-year CAGR, 23%, and we flipped the coin and added some premium on the management, gives us 1.2 billion incremental valuation on this business. Now, there are risks to this, but we want to focus mainly on the COVID reopening. They had a 30% revenue growth during COVID, and people were really worried about the churn rate after COVID. Well, we actually tried to do it not to be on the what happened during the COVID. This is their YouTube channel engagement, and you can see all the spikes actually coincided with the releases of new games or new topics instead of COVID lockdowns. And the most recent spike on the engagement actually happened after reopening. The other measure we have is the secondhand market, because I own a bunch of miniatures and they're very expensive. So if I don't want to play with them anymore, I'll sell it on eBay for 200 to 500% markups. But we don't see a flood of used miniatures online, and the price remains very elevated. So that's why we're confident that the churn rate and the supposed disinterest are heavily overestimated. That's why we're comfortable with high conviction about the 20% base IRR, and we're open to questions. Thank you. Oh, sorry. If the judges are interested, this is their competitors' quality. You can easily tell the difference.
You have to see their hands.
Yeah, the hands are the hardest part to paint. So you can see the details in hands are very different.
Thank you for that great presentation. My question is around, how do you get comfortable having your whole investment in one world of IP, right? In terms of, I buy it that like existing customers are going to continue to stay with it because it's, they're bought into the franchise. But, for new customers, you're kind of in the attention business, right? And, can you wake up one day and Warhammer is no longer cool to a new generation or something like that? How do you think about that?
Right, so we have two responses to that. The first is that, in general, the recent management change has brought about significant improvements to the IP management process. So if you look, for instance, at how selective they've been with their recent IP partners, as well as their recent releases. For instance, Total War Warhammer 3, a video game, had about 5 million downloads in the first 2 months, which is like stupendous for a relatively unknown IP. That suggests to us that there's certain structural factors at play that means that the IP will not be under threat anytime soon. That's the first thing. The second thing is that we would say that this IP has been around for like well over 30 years as well, through the creation of the internet, through the creation of multimedia, through the creation of now Web3 and everything else. We think that this is something that's likely to have some staying power at the very least, and we think that this is likely to continue into the future. So long story short, we don't see any signs at the moment. I think if we flip over to slide 46, we have actually done some analysis on how previous IPs that fail usually have certain warning signs. These warning signs do not yet exist for Warhammer at the moment.
Hi, thank you for that. Question around something you touched on in your risk section. You talk about the, sorry, is that better?
Yeah.
Thank you for that. Question about something you talked about in your risk section. You mentioned trying to understand the risk of the COVID bump and what reopening means. I'm curious, have you guys done any analyses trying to understand better, like the growth bump in 21, how much of that was existing users doing more and new users, just to try and understand, like, as we come off of that high, what that means for growth into 22 and beyond?
So first of all, we'd like to point out that this slide actually shows that, in general, the sort of engagement with Warhammer is rising over time. So this is the first sort of response to the concerns about pre-COVID bump. If you're asking more specifically about the breakdown of how they've basically exploded in revenue over the 2020-2021 period, about 5% of it came from customer base growth, about 5% of it as well came from price growth, and the remainder was actually an improvement in customer engagement growth. So that was actually a sign that people were being more and more engaged with Warhammer. Given that sort of background and the fact that we have seen easily 10-15% customer engagement growth, that means people buying more Warhammer products, we think that at 2%, which is what we have actually put in our projections going forward, is actually very, very conservative as a result.
How do you think about what the potential market opportunity, I mean, this strikes me, again, just my naive perception, it's pretty niche, right? It doesn't surprise me that there's 1 million people that are hobbyists in this realm. But in order for this business to grow at a reasonable rate over a long period of time, compounding is a wonderful thing, but it means you're going to have to, the number of people in the world is not growing at 15% compounded. So how do they take, if you will, market share? Maybe it's really similar to Anthony's question. Perhaps you can sell anything to 1 million people, but can you sell it to 10 million people? And,
right.
And by the way, interesting question would be, where are these people located in terms of geography?
They're worldwide customers. The most recent expansion has actually been into sort of East Asia or Central Europe countries. Primarily, the company started in Nottingham, so that's the UK. So obviously, they have a lot of customers there. They have about 25% of their revenue from the United States as well. Just to answer
as a percentage of the addressable market in their kind of where the UK is today, like if the addressable market is, I don't know, 12-year-old to 30-year-old boys, my guess, something like that, mostly boys.
Yeah, that's true.
Okay.
That's why we're pitching it.
So, okay, I guess 50 years old, so I guess I'm now out of the market, but what percentage are they in the UK in terms of penetration, and where are they in kind of their next best country, et cetera?
That's a good question. I think primarily the UK has the highest level of penetration at the moment. I will confess I don't have the specific penetration numbers per se, but if you go back to the overall total addressable market, I believe within the first slide of the first thesis point, which is about SAM growth, they are about 3.5% of the total base growth. Just to give you a flavor as well of how much more potential they have to grow. So Dungeons & Dragons, which is like the next equally nerdy thing here, has about 50 million regular customers today. This by a simple Google search, by the way, 50 million. We are projecting 1.5 million today. On a 5% growth for the next 5 years, which was our customer base growth, or even 10% growth, that gets us to what? 2 million, 2.5?
Again, it's been a while since I've looked at Dungeons & Dragons, but that to me is more, there's a broader market for it, because you don't need to, perhaps there are people who collect characters and paint them, but it seems like this is more of there's an artistic element of this,
Yes.
Whereas Dungeons & Dragons is more about creating stories and fantasies, which seems a potentially broader market. But how do you respond to that?
You're right in that is the difference. But again, as we point out,
I think more, boys and girls and men and women play Dungeons and Dragons.
That's true. Yeah. But again, as we point out, if you're talking about 2 million players in about 5 years compared to Dungeons & Dragons at 50%, we don't think Dungeons & Dragons is 25 times more accessible than Warhammer. It's a lot more accessible because it's a different thing, but we don't think it's necessarily that much more so. So even on that sort of conservative projections, because it is such a small base, we think this growth is relatively sustainable over the sort of like 5-year period that we're talking about.
Okay, but in order for it to be worth what you want it to be worth, it's not about just getting from 1 million to 2 million.
Yeah.
It's going from 1 million to 2 million to 4 million to 8 million to 16 million over time, right? It's the present value of the future cash flows. I wouldn't put the multiple that you're putting on this business unless it's not going to, your assumption isn't it's 5 years of growth and it stops. What is your growth assumption for years 5 through 20?
5 to 20. I think goes back to 4% because, so I believe your question is what's behind the growth, right? What they really do to drive more people to play this game. Because, the nerds are just like these and a very small fraction of them can do arts and craft like this. So what they did was after the management change, they made the game easier and they made them basically easier to go into, easier to play. That's one thing for the legacy business. And we can see that not everyone's into this. and we're not going to see like 10 million, 20 million people doing this. But even if the growth, we're seeing 5% growth, and even if we can have like 2 million, 3 million people playing this, it's going to be an incremental growth on the revenue side. The other thing is the IP business, and that's what they're trying to do to get the IP known to other people, because they have, if you look at this depth of the IP, like Transformers, they have toys, and not everyone's into toys or like cars becoming humans, but people are into watching movies, reading books, and basically seeing explosions everywhere. And that's a big potential for them to grow beyond the 3 million potential players, say in 10 years.
Can you show us in your model what your projected growth is in kind of the core toy business after year 5?
Year 5, I believe eventually it slowed down from 12% to 2030, it slowed down to 9%, 9%.
Okay, but you're still, okay. All right, thank you. Other questions? Okay, no further questions. Thank you, excellent presentation.
Thank you.
We have to.
Test.
Okay.
Mine doesn't work.
Test.
All right.
No.
Is it on? Hello? Okay, sorry about that. All right. Bill, Jillian, Whitney, Ryan, Anthony, Manning, and Janice, thank you so much for coming
Excellent
tonight.
presentation.
What if we tell you there's a mediocre business that shot to the moon, currently trading at 300 times forward PE and 32 times forward EV over EBITDA, and its stock pair recently crashed over 60% in less than 6 months, and we believe this company will follow suit. Are you interested? Are you excited? If you are, welcome to our idea, PGNY. Progeny Inc., with a ticker symbol PGNY, currently trades on NASDAQ with a 3.6 billion market cap and a $40 stock price. We believe that this company is a short with a $21 9-month price target, reflecting a 48% downside and a 64% IRR. That is based on our 22% variance in gross profit forecast for 2023, based on 3 key reasons: new client acquisition deceleration, existing client deterioration in contribution, and lack of margin expansion going forward. So what is this Progeny? Progeny is a middleman that connects fertility clinics and large US self-insured employers. They take a 20% fee cut as gross profit and pay the rest to the clinics. They have 265 clients. They came in around 2017 and they seized market share from United Health, Aetna, by offering a premium fertility product. And they attracted clients like Google, Meta, Microsoft, who want to go above and beyond to retain their employees. So the market thinks that this stock is a buy, but we disagree. And why? Here's the first reason: new client acquisition deceleration. We believe that Progeny's TAM is way overestimated. They claim a 3% penetration into a long growth runway of 8,000 US employers. We took a look at all that 8,000 and found out that over 80% are either too small or too hard to penetrate. And by too hard, we mean that they're either in industries that don't look at fertility traditionally, like manufacturing, construction, etc., or they're government agencies. And in that 1,500 left as the real TAM, 70% has already been penetrated by Progeny and its competitors, leaving only 465 for penetration, which drives our 85 new client addition for 2023, and that translates into a 6% difference in our forecast versus consensus in the top line. So you might want to ask, well, does this business expand their market share? And our answer is no, they don't.
In the last 3 years, we see rapid rise of competitive pressure for this company. We also see the increasing decrease of the clients in the size acquired. And we forecast that trend to continue, which translates into an additional 5% decline in our forecast versus the consensus. We want to highlight this company, a very important and interesting competitor who we believe is a disruptor, Kindbody. Kindbody owns 26 clinics and partners with 300 more, and they skip the middleman and offer directly to employers. And through our extensive primary research, we have found out that this company offers a 20% discount for the exact same services. If more companies like this show up, why should Progeny exist? Although we didn't model it this way, if that happens, we expect the investment return to exceed our most optimistic case forecast. And I'll hand it to Bohan.
So, our second thesis. We think Progeny, if they have intensified competition and have narrow moat, why Progeny claim a nearly 100% retention rate? This number is very problematic. Progeny signed a 3-year contract with the client. That means for the clients only on board before 2019 have a chance to switch. That's 33 of the 265 visit clients. Of the 33, we already found one switcher. The large gaming company switched to Kindbody. And the VP of Benefit told us they are not happy about price transparency, and they think the switch is a good choice. And switching cost is very minimal. We think Progeny will face increasing pressure on contract renewal, and that will translate into -4% variance to the consensus top line next year. So, more importantly, Progeny is the business model is misunderstood by the market. Analysts use the mental health model, the growth curve, to picture the future of Progeny. But mental health, consultancy, they have repetitive use and recurring revenue versus Progeny. It's a fertility benefits, limited use, lifetime cap. So the higher utilization rate, the faster it will peak. We'll circle this back in our catalyst part. So let's talk about a little bit more about gross margin. The market thinks the gross margin will expand 130 bips every year. We disagree. Because for 3 reasons. Number one, the upselling products is already achieved its penetration limit. And number 2, the sales commission delay is a one-time boost. And number 3, the asymmetry of demand and supply in the clinics industry. The demand is growing really fast, create a 6-month backlog in the clinics, and that will prevent Progeny to gain purchasing power. But the supply will expect it to be constant, as there are only 33 practitioners graduated last year in the United States. So most conservative measure, that will stay flat, gross profit margin. So finally, we think the governance issue is problematic. Last year, Progeny changed the executive bonus criteria from financial metric to those vague criteria. During the same time, top executives sold 60% of their shares with no press floor. And also, the PVC sponsors sold the majority of their holdings. We believe words speak louder than our actions speak louder than words. So those actions clearly demonstrate management have no skin in the game and also have no confidence about the company. So in short, we want to talk about catalysts. As we mentioned, the dependable nature of the business. The top 1 client, Google, will reach the peak revenue in less than 12 months. That means it will trigger a -6 variance to the consensus revenue next year. More importantly, they will wake the market to rethink about this business, to shatter the growth story, and to squeeze the critical multiples. So how severe is that going to be? The peer comparable company, GDRX, last year with a similar business model, similar time, and very similar margins. We need to achieve -15-point difference between versus the consensus. It wiped out 45% of the market value. Then another 45% 3 months after the next quarter. So we think Pershing will follow. And Pershing, we think, is the right taker to short at the right time to short.
So our key assumptions for the base case scenario remain constant to the historical level in terms of new client additions, churn, and female utilization. We also assume that there's no gross margin expansion. And in terms of valuation, we use EV over gross profit to better capture the middleman business nature of Progeny. We use a set of 12 comps in healthcare, IT, and medical care industry and arrive at 10.9 multiple in our base case scenario 2023. That gives us a price target of $21, representing a 48% downside and 68% IRR. We find it's a very attractive risk-reward profile. And we cross-check with a DCF analysis, which also gave us a $21 price target. And in terms of risks, we see that the unexpected acquisition of a large quality client remains to be a very key issue here. But we don't think that is likely because the Fortune 100 client market has already been saturated. We also see that the initial growth may be faster than we expected, but we don't think that the fast growth will translate directly into Progeny's growth. And in summary, we're recommending a short on Progeny based on a 9-month price target of $21. We would like to conclude our pitch by showing you that unlike Progeny's management team, our team is our own cooking. We have personally shorted $11,000 worth of Progeny stocks with our own money, and we believe you should do the same. With that, we're open to questions.
Great presentation. Can you talk to two things? One is if you've looked at the FOIA, if you've done a Freedom of Information Act search on the company, it looks like there's been some activity since 2021. And then the second question is, how do you expect management to react in terms of, what's the potential exit here? Could they sell the company? Is it, accretive to another firm? Just on the company's filings activity, if there's any regulatory. Oh, yes, SEC. Yeah.
Can you repeat the first part of your question?
Sorry.
We cannot hear it a little bit.
I think what she's saying is, oftentimes short sellers will send a Freedom of Information Act request to a government regulator to see if they can glean whether there's any investigative activity. Has the SEC, the Department of Justice, opened an inquiry into the company? And oftentimes you don't get much back, but occasionally you get something. Just curious as to whether you've done that.
We haven't.
Okay. What was your second question?
About the potential exit for the company. So could it be potentially accretive to someone else?
Yes. Yeah. Definitely. So on page 48 of the appendix, we have our primary research quotes. So we have heard from sell-side analysts and as well as from the company itself that first of all, fertility is not a main revenue driver for big companies like United Health and Aetna, and also they're not even considering right now, given that there's a lot going on in other spaces that can drive their revenue. And also, if they do this, if they acquire Progeny, they will have to change their existing client structure, and that will take a lot of onboarding and also money. And also on page 78, I believe. 79 actually. On page 79, we actually listed out the potential acquirers and we looked at who can potentially buy this company. And we saw that companies that we listed out like United Health, BCBS, they either already acquired somebody in the space and have the platform built out, or they're not focused on acquisition like Win Fertility, or they just have a very different business model. So we think it's unlikely, at least in the next 9 months. And also, we did see some investigative activity into this firm. We saw the news, but we probably should have done more work on that. We'll get back to you. Thank you.
If just from a competitive standpoint, the DTC competitor, I think as you referred to it,
yes.
Is Activision Blizzard, when they got rid of Progeny, Do they make a deal with KindBody, if that's what it was
They
called?
did.
Yes.
They did. They
Okay,
switched
so
it.
it's not, when we say direct to consumer, isn't that a business sale? So explain how that works.
Right, I'm gonna start. For KindBody, own clinics, unlike Pershing, Pershing only benefit management, only do the benefit management. KindBody own 26, partner with another 300 to offer a similar service as Pershing. So Activision Blizzard switched to KindBody because KindBody in the value proposition, KindBody, those clinics capture a larger share of the revenue rather than the middleman service. They can undercut Pershing. They guarantee a 20% price decrease than Pershing. And also, Activision Blizzard, their VP of benefit, believes the company who owns clinics will provide better clinical outcomes and better control of the outcomes.
We also asked him, would you switch again if there's an even cheaper option? And he's like, yes, in a heartbeat, because this service is essentially commoditized. And if there is a cheaper option that's offering the same thing, he would like to save cost.
Okay. What was my follow-on question? Go ahead, Whitney.
Just feedback to all presentations. The first slide should be a basic description of the business, not just to you, but to everyone. Somewhere in the first few slides, throw up a 5-year stock chart or whatever, so we can get some sense. Are you shorting something that's already down 50% or something that's gone up 5x? Throw up a stock chart, always, in every presentation, somewhere up front. And my question is, when I've been burned on the short side, is often when a company is generating cash flows and therefore they can buy back stock or do, so can you show me the chart that shows me, does this company burn cash, does it break even, or does it generate cash?
So, yes, go to our, second. So this company do generate free cash flow, and thanks for pointing that out. I'm going to show it here. The company has been very clear that they will not issue dividends, so that's not something they're looking to.
Stop on the cash flow statement.
All right, absolutely. So they have made it very clear that they're not going to issue any dividends. Great, you got it. All right, and also they have historically bought back a little bit of stock, but at the same time, they issue a lot of stock to management, and that creates an even much larger dilution in our opinion.
That's right.
Projecting operating cash flow goes up 6x in the next 4 years.
Yes, we pile all the cash on the balance sheet. But with the thing we will cash out in less than 12 months. Our time horizon is 9 months. We believe there will.
Oh, you're cashing out in 9 months in a year when $5 million according to your projection? Sounds like a long to me.
Thanks for that question. So the way we think about it is that
Did you really want to thank him for that question?
we love challenges. That's why we're here. Pitching you are short. We love challenges, and we're going to take every question seriously. That's a great question. So the way that we think about this is that even if we're forecasting them having a lot of cash, that doesn't change the fact that the market puts their eyes on the growth coming down, and really it's the uncertainty that will really freak people out. They're not going to think about, oh, this company has cash, and maybe they'll have more cash in several years later. They're thinking about, oh my God, this company's growth forecast is not what we think, and that will trigger the miss, in my opinion.
If you look up to the top, you're shorting it because net income's going down by 1/3. You're projecting this year, and then the balance sheet stuff. I would just caution you that company, even if net income's going down, if it actually is somehow generating a bunch of cash, that gives the company some flexibility and/or might be attractive to acquirers. So,
Understood.
So are they consuming, the deceleration in growth is what is freeing up a lot of free cash flow? Is the nature of the business, the way they pay the clinics, such that working capital consumes a lot of cash? Is that what happens?
Not really. It's a very capital-light business. It's only the middleman. It's only the agency business.
Then why is there such a dramatic change in your model, right, in cash from operations going from 26 million, it was headed down, and then it's up almost 4x 2021 versus 2022, and that's based on a change in accounts receivable, which implies that something about, maybe the growth decelerates. Something about this business, the the nature of it's the way when they pay their customers is consuming cash, yes or no?
I think we made a mistake about the stock price composition. I think that's the reason why it's generating so much cash on the balance sheet.
I'm not so much talking about cash on the balance sheet. I'm talking about cash from the operations of the business. Like if you look at, I'm just quickly looking at your number. Stock-based comp? No. I'm just looking at change in accounts receivable, right? That's a $45 million swing
Right.
to the favor. If it's a capital light business. Yeah, that's 100 million. That's okay. So one other question on Kindbody. Did you talk to them? I mean,
Yes, we did.
So
did they lose any customers to Progeny?
No, Kindbody actually started business in 2019.
Okay.
Kindbody, we talked to their CMO about their business model, and they never lose because it's a relatively new company, and it only gain market share from others, never lose a customer.
Okay.
Not that we are aware of.
Great presentation. Can you talk a little bit about, why, I guess, Progeny can't just move down market? I understand that they've, saturated the Fortune 100, but it seems like fertility benefits, provides a lot of value to employees. Seems like, this would be interesting to employees outside of the Fortune 100. So what are the barriers to entry there?
Definitely. First of all, the company discloses that they do not target employers less than 1,000 people, and their current strategy is to focus on the other half. So that's something that definitely they do not have on mind yet. So that's the first thing. And also, we see smaller employers as less attractive in terms of the value they can provide to Progeny. So the way we think about it is that larger companies, they buy more cycles. Because Progeny groups their products in cycles, they have a deeper pocket and are willing to pay much more. And smaller companies usually only cover maybe one cycle, and that would only translate into a very small increase. So essentially, if they move down the market, they have to find a lot more people to replace, maybe never replace the loss. That's why.
I want to add 2 points. First, Progeny only now have 22 salespersons. If it goes to really small market, they will not easy to go to them to acquire them in less than a year. And number 2, the Progeny business is for the national infertility problem only capture about 6% of the people. So 6% of people with less than 1,000 employees, that won't change a lot of money, a lot of income for Progeny. So we think that's not going to be a top priority for Progeny next year.
So Jillian, you've covered energy and renewables, so I'm going to pick on you on this one a little bit. The way we think about it is that Google, Meta, those are the Permian Basin, and they're pretty much almost drilling through, and they need to replace that, and it's kind of impossible. Thank you so much.
Testing.
What's up? Yes, thank you. You guys are gonna kill it. Oh, shit.
Hi, I know what you've been waiting for. You've been eagerly waiting to hear why PayPal is a great investment opportunity. My name is Mathesh Marthaliru.
I'm Jake Wheelock. And I'm Ian Gorman.
So what exactly does PayPal do? It's very simple. It's a leading platform that enables online digital payments transactions. So in the top left, you can see how they make money. It's total volume times take rate, you get total revenue. PayPal operations span across peer-to-peer transactions with Venmo, online checkout, in-person checkout, payment processing, and other services. In the next slide, we get to our thesis. We expect 32% IRR through year-end 2025. The stock is down 80% since peak of last year. The market has unfairly punished PayPal for near-term transitory issues related to eBay rolling off and miscommunications with the street. These issues should pass, allowing you an opportunity to long a derated, high-quality compounder like PayPal. Thesis points include shifting customer acquisition strategy, powerful engagement drivers, call option on Venmo monetization, margin expansion, and tremendous capital return potential. In the next slide, we get to our value proposition for consumers. It's a comprehensive user experience from payments to financial services. In the top right, you can see that consumers pay 0 transaction fees when purchasing using PayPal online. In the next slide, we see the value proposition for merchants. It's a holistic experience spanning from security to credit to data analytics. The checkout conversion rate using PayPal is 90% versus 49% conversion for all other payment types. In the next slide, we see how PayPal is a compounding machine with a deep and wide competitive moat. There's two-sided network effects and tremendous economies of scale. In the next slide, we get into Thesis 1. There's a shifting customer acquisition strategy. There's currently a market misperception. The focus is not on new account creation. Rather, the focus is on engagement and higher value consumers. In fact, PayPal will start to disclose MAUs and ARPU metrics to show commitment towards this strategy. In the next slide, we break down the revenue growth algorithm. So 1 is average active accounts. Historically, it's grown at 15% CAGR. Consensus has it modeled at 6.6% CAGR going forward. This is too low. We see 200 basis points upside for this metric. For 2, transactions per account, and 3, TPV per transaction, these are also growing, but we're fairly in line with consensus estimates. In the next slide, we see 4, what's happening with take rate. We expect take rate to stabilize around the pandemic trough. However, consensus sees a downward sloping negative red line and just extrapolates that to perpetuity. Consensus estimates don't seem to fully appreciate that eBay is fully rolling off this year and will no longer be a headwind for take rate. And there was a 20% pricing hike for US merchants late last year. At the bottom, we see total revenue. It's growing at 21% CAGR going forward. Consensus models 18%. 18% is a historical average. They're just taking the historical average and extrapolating it without considering all these other moving pieces.
Thanks, Mitesh. Our second thesis point is powerful engagement and volume growth drivers. So there are really 3 parts to this. The first is an expanding super app ecosystem. So PayPal released the super app in October 2021. And this is basically the culmination of years of M&A and is really the company's first big product innovation since its one-touch feature in 2014. The super app makes PayPal into a consumer finance hub and includes things like bill pay, shopping deals, high-yield savings accounts, and yes, even crypto investing. PayPal has disclosed that super app users generate double the average revenue per account compared to checkout-only users, so early results are promising. The second is buy now, pay later. So PayPal was really late to the game here and only came out with their offering in August 2020. But their run rate total payment volume is now $13 billion. We think US penetration rates for BNPL will increase from 4% of e-commerce to something like 10%, like we see in Europe and Australia. PayPal BNPL has best-in-class value proposition for consumers and merchants and comes at high incremental margins. And third, secular e-commerce growth. Tough comps with COVID for e-commerce notwithstanding, there's this inevitable shift from in-store to e-commerce, and eMarketer projects 13.5% CAGR for the next 5 years. Our third thesis is call option on Venmo monetization in-store. So Venmo was acquired as part of the Braintree acquisition in 2013, but the company didn't start monetizing the asset until Q4 2019. Venmo currently generates $900 million of revenue on $230 billion of total payment volume. We think the pandemic and the resulting once-in-a-generation shift in consumer payment habits opens the door for Venmo to capture in-store transactions, which have historically been pretty elusive for the company. We think this is a valuable call option that comes at high incremental margins. And if anyone doesn't know what Venmo is and is interested in a live demo, you can scan any of the 3 barcodes on the screen and practice donating to students in need. Our fourth thesis point is high operating leverage driving margin expansion. So we reconstructed PayPal's historical financials and found that around 60% of non-transaction expenses are completely fixed. We think that incremental operating margins are around at least 22%. So going forward, as total payment volumes continue to grow, we see margins expanding. Thanks, Jake. Our final thesis point is PayPal's underappreciated capital return potential. As we show on the top left, PayPal has always been significantly free cash flow positive ever since the spinoff from eBay, and a slim majority of that free cash flow has historically been used to buy back stock. Looking forward, while we expect PayPal to generate more than $50 billion of free cash flow over the next 5 years, with theoretical capacity to retire nearly 90% of all shares outstanding if they were to add some debt to the balance sheet, consensus only expects cumulative buybacks of about $4 billion over the next 5 years. Now, this might be a shot in the dark, but if there happen to be any activist investors in our midst over here, we think that this creates an opportunity to, one, encourage management to take advantage and capitalize on this buyback potential, and two, also improve strategically a bit. On the latter, management has been a bit slow to pick some low-hanging fruit, such as marketing and monetizing Venmo, and also expanding the super app. And so we think encouraging them to focus more on product development and less on acquisitions, like their 2021 proposal to acquire Pinterest, could be a step in the right direction. And one specific action that we think they could take would be to hire a product-focused COO, because that's actually a role that's been vacant since the last COO left for Google about 2 years ago. Moving on to our valuation, we lay out our base case price target for year-end 2025 of $232, which with the stock at 84 implies an IRR of 32%. In broad strokes, we expect 8% account CAGR coupled with 9% transaction per account CAGR to drive 21% revenue growth over the next 5 years. Coupling this with the buybacks and the operating leverage that we mentioned earlier, we expect this to translate to a 32% EPS CAGR. From there, we apply a 20 times target multiple, which is roughly where the stock is trading right now, and also falls at the lower end of the range between the Visa and MasterCard duopoly and the more challenged group of traditional acquirers, which we think appropriately reflects PayPal's competitive positioning within the broader payments value chain. And I would also highlight that we estimate a 3-to-1 upside-downside skew in our bull and bear cases, which we view as further testament to the attractiveness of PayPal's valuation at the current share price. Finally, on slide 15, we of course want to acknowledge that all investment opportunities come with risks and that PayPal's no exception to this, so we've laid them out right here. And to close, we think that shifting customer acquisition, increased engagement, Venmo monetization, improving margins and capital return potential backstop a very attractive fundamental outlook for PayPal for years to come. The stock has been unfairly punished by the market, which we think creates a very exciting opportunity to buy into a high-quality compounder with a deep moat that's very durable. Thank you very much, and we would love to take your questions.
Great presentation. So my question is on the competitive landscape. So I think PayPal was one of the first, checkout buttons out there. They've done amazingly well. They have, very, very high merchant penetration and customer awareness. But I think what we've realized over the past several years, especially, is just the influx of new payment options. BNPL being one of them. All these new kind of tech-enabled players entering the market. How do you see PayPal, defending its existing market share versus all these new competitors, as well as their ability to, keep growing, given that they're such a large incumbent?
So I think from a high level, when PayPal first came out as part of eBay, it solved a really big problem with e-commerce where neither party, the merchant or the consumer, trusted each other, and PayPal was the trusted intermediary, and it developed this really big brand cachet. And today we see that in conversion rates. So PayPal still drives the best conversion rates in the industry compared to other digital wallets and other payment types. And so for merchants, it is you absolutely need PayPal as one of your payment options because it still has this big conversion lift compared to other options.
You actually know the number for Stripe on conversions?
No, we don't.
You're looking at an average of other digital wallets comparing with PayPal.
Correct. Yeah.
Which includes the bad ones and the best ones, right?
Correct.
With respect to Stripe in particular, so Stripe targets more towards smaller businesses, and these businesses need more of a fixed payment solution, whereas PayPal is more flexible in terms of its value proposition to merchants. You can pick and choose what type of services that you want through PayPal, including like data or security or other types of analytics, whereas Stripe has this fixed bundle. So as companies evolve, they actually prefer to shift over to a PayPal-type solution instead of sticking with Stripe.
Do we have any data on that in terms of, I know Stripe's a pretty ambitious company. They got a pretty big market cap. I think their private market cap might now be the same or higher, actually maybe even higher than PayPal's. So at least the private market's been saying that it's a super valuable company. Do you have any evidence on people switching from Stripe to PayPal or vice versa?
So we don't have a concrete data point that says X percentage of customers of Stripe actually transferred to PayPal. What we could provide is relatively PayPal is still gaining market share because there's such a huge greenfield. Like e-commerce market within US is growing 13.5% CAGR, whereas PayPal is growing 20%, high teens percent CAGR. So PayPal is taking market share and the e-commerce market is growing. So there's a huge pie out there, but we don't have that exact what percentage of Stripe merchants are transferring over to PayPal.
Maybe if I could just highlight one more thing. PayPal is sort of untouchable in the world of small and medium-sized enterprises. I think Stripe is generally more catered towards up-and-coming tech companies, like they were on Airbnb, for example. And so I think very small merchants like PayPal because it doesn't require very much coding to implement. And then they also have this big network of customers that's sort of second to none with about 400 million people. So that's a place where they really outshine Stripe.
So one thing that you talked about as a positive was that they're trying to build a super app. Inside of that, they have things like deposits, savings accounts. They also have buy now, pay later. Those things start to look more like a capital-intensive bank, whereas historically the business model has been a very capital-light growth annuity. At the same time, they had this weird sort of acquisition dance with Pinterest. You've had the COO leave in the last 2 years. I think just a couple weeks ago, the CFO left to go to Walmart. There's been a lot of turnover. So it kind of seems at a high level, while it seems to be a very attractive market, you've had a company that operates in a very attractive, very fast-growing market that seems to be moving away from its core model towards a more capital-intensive model, potentially acquisitions for which there don't seem to be a lot of synergies or clarity in the models. And then you've had a lot of management turnover recently. What do you make of all of that, and does that maybe give you any indication as to how management might be thinking about the opportunities for capital-light growth in the future?
So BNPL is definitely a capital-intensive option that they're entering, but I think other things like trying to better monetize Venmo don't necessarily fall into that bucket. And in terms of the management, I think they've basically admitted that they haven't been doing this right after the stock has fallen by 80%. They noted that some of the acquisition strategy and whatnot wasn't as sensible as just focusing more on core product development and doing things like, again, making this super app more competitive with what the Cash App has done in recent years. And so there's probably still more work to do, and that's why we suggested perhaps maybe bringing in a new COO. But it's good. It's encouraging it to us at least to see that they are sort of acknowledging that they made a mistake after having such a dominant position that they perhaps took for granted.
Including the latter part of your question about in terms of management change. So the CFO leaving, we actually see that as a step forward in the right direction because PayPal has been inconsistent with its messaging to Street, which is one of the reasons why the stock catered. And especially in the most recent earnings call, management actually talks about, they acknowledge that they've made capital allocation mistakes before, and they don't want to do large, tremendous M&A going forward. So they're aware that there was an issue, and they want to be more focused capital allocators.
Hi, guys. Thank you for this. 2 questions. One, tell me if I'm reading this incorrectly, but it looks like you have revenue modeled forward growing at 20%. I think you talked about industry estimates for e-commerce growing low to mid-teens, which is kind of what it was doing pre-pandemic. Curious how you guys get comfort around PayPal growing 2x the rate of the industry, given their, they touch 1/3 of US e-commerce already. And then secondly, you alluded to this just now, but thoughts on your thoughts on management credibility, given what's happened in the past couple of quarters, especially yesterday with the cut to guidance and the pull long-term on medium-term guide.
Revenue build, Mitesh?
Sure. So in terms of how to think about the revenue growth going forward, so within the e-commerce landscape, so US e-commerce is growing 13.5%. Of that growth, say half of it goes to Amazon. Of the rest of it, PayPal has its eyes in terms of e-commerce growth. When we think about the build-up to total revenue growth, we had the different revenue drivers outlined, where we do have a step down in terms of new customer account creation. But the 390 million that are currently on the platform, that's global customers across 200 different regulatory markets. So it's not just US demand, but it's rather global demand that they're trying to expand into. And there's plenty of white space as you have these huge growth wins in terms of digitalization and e-commerce and shift in customer habits going away from cash to plastic to electronic.
Question. When I look at a stock like this that's down so much and it's a falling growth stock, I'm trying to think, okay, when do value investors start to come in? Because that's where it bottoms, right? When the last growth investors puked it out. And so I sort of look for almost like a bounce or something. So today or after the close yesterday, they reported earnings. I'd like you to comment on the earnings, but my quick take, I just quickly pulled it up, is it was a horrible quarter. Earnings, operating cash flow, free cash flow down 28 to 32%. They took down guidance for the year from 460, 470 to 390. So had you told me that, I would have said, okay, the stock's down another 20% today. Instead, it's up 11%, which sort of reminds me of what Facebook did today. Facebook stock I've been very bullish on. So this is actually something I like to see. Like, it sort of tells me this is the kitchen sink quarter. Expectations were so low that even pretty grim numbers, the stock is popping on that, right? What's your take on the fundamentals of the quarter if you had a chance to review it? You know, I'm sure you were preparing for this today.
It was yesterday after close.
It was after the close yesterday.
Yes.
So today's pop reflects the new news of their first quarter earnings report. So talk to me about the fundamentals and then, I don't know, the technicals or whatever. Do you see this? Is this a bottom?
Few responses to that, and then can layer in. But essentially, going into the quarter, a lot of investors and the sell side actually thought that guidance would be taken down. Because when the CFO left several weeks ago, they actually didn't reiterate guidance, which would be standard practice. So this was taken as a kitchen sink quarter, especially with the CFO leaving. So get rid of everything, all the mistakes that they made, especially last year, at the height of the pandemic, when e-commerce was booming a lot more than it is with the steady state growth trajectory going forward. What PayPal did is they took that huge growth wave and they extrapolated it. So that was just complete mismessaging on these macro level data points. With respect to the quarter itself, like, take rate was fairly in line quarter over quarter. And take rate is one of the key factors that we should be trying to be aware of. Net adds for new customers was light. But PayPal did talk about this dynamic where they expect rolling off of less engaged customers, which is why we talked about how the focus isn't on new customer growth, but rather higher engagement of customers. And then with respect to the pulling away of guidance, so we don't see that as an impairment of the terminal value. Rather, it provides PayPal flexibility going forward to give better messaging and to reset the base.
One thing that I might highlight about it that maybe goes back to the question about our revenue growth, excluding eBay, which is rolling off, transactions per account on an annualized basis were up about 19%. Historically, that growth rate has been closer to, yeah, we have it right there, 9%. So that's an early sign that this engagement program is working, which we were really pleased to see. Thank you.
Hello.
Good evening, everyone. My name is Jason Lay, and today, along with my colleagues Mike Dunleavy and Jeremy Miles, we're going to pitch to you our investment thesis on Tandem Diabetes Care. The stock is currently trading at $101, and we are proposing a 2027 price target of $285 for an IRR of 20%. Tandem Diabetes Care, or Tandem, is the third largest insulin pump manufacturer behind Medtronic and Insulet. Its flagship product is the t:slim X2, the smallest durable insulin pump available in the market, and known for providing patients with a simple, easy-to-use user experience. Our investment thesis is based on 4 points. First, market expansion of insulin pump users. Second, market share gain within the insulin pump industry due to having what is the most accurate insulin pump for controlling blood glucose and offering users a highly rated user experience. Third, growth in international markets. And fourth, margin expansion through operating leverage. Our base case 20% IRR is based on a 23% revenue CAGR and 36x P exit multiple in 2027. So first, some background information. There are 2 types of diabetes. Type 1, where your body cannot produce insulin naturally, and type 2, where your body cannot regulate insulin production properly. The TAM for insulin pumps is all type 1 diabetes patients and insulin-intensive type 2 diabetes patients. Now, essentially the way insulin pumps works is you have a continuous glucose monitor, or CGM, which measures your blood sugar. Tandem's products currently uses Dexcom as its CGM. Then the insulin pump automatically administers insulin to make sure your blood glucose is not too high and not too low. The pump's ability to maintain your blood glucose within a certain range is measured using a metric called time in range. Now, what really makes Tandem stand out is this proprietary Control-IQ technology, which delivers industry-leading time and range performance. Tandem has a unique algorithm that essentially predicts your glucose 30 minutes in the future, then automatically adjusts your insulin dose based on your insulin need. Now, my colleague Jeremy will talk more about our investment thesis.
So insulin pumps are the best way to treat diabetes, and we think that we're at the cusp of a marked inflection in the penetration of pumps, bless you, in the type 1 diabetes segment and in the type 2 diabetes segment. So really, to compare and to explain why we think insulin pumps are a superior treatment option to multiple daily injections of MDI, let's go through a day-in-the-life example, an experience. On the left, you have the daily routine of someone who needs to inject themselves to treat their diabetes. And on the right, you have the pump solution. So basically, if you're on MDI, you have to inject yourself first in the morning when you wake up, and then in the evening before you go to bed, to get that sort of long-acting, what they call basal insulin, which is your background level. And then before every meal, you need to calculate, or really estimate, the amount of carbohydrates that you're going to ingest, and then translate that into volume of insulin that you'll need to inject. And then between all of those interactions, you'll need to test your glucose level in your bloodstream to see that you're in range, because those things change based on stress and exercise. And the pump obviates a lot of those interactions. Really, the only thing that you need to do is check the data that's coming out of your CGM and check your pump, and then tell your pump what you're going to eat. And then the rest is sort of managed by itself. And that's a dramatic reduction in the number of interactions and the burden of the disease, which we think is significant in the pickup of this product. So pump penetration in type 1 diabetes segment in 2015 was 30%. It's 36% today. So why the inflection to 54? Well, we think the automated closed-loop pumps, which have recently come onto the market, are a complete game changer and are going to give up a step rate in adoption. So in the old world, you needed to calibrate your CGM. You basically need to tell it based on its measurement and your own finger prick to match the output, essentially. You need to use finger prick tests, basically, to measure your blood glucose, and then feed that data into the pump so it knew what was going on. And you had to do that through a very old world UX, which wasn't very patient-friendly and had little smartphone operability. In the new world, you don't need to calibrate the CGM. Pump interactions basically are limited to changing the site of the injection every 3 days. It's operated through smartphone apps, much more practical, much less discomfort for patients, and that's really what matters at the end of the day. So now that we've established that this market is going to grow, we think Tandem can win, and for 3 main reasons. First, we think it has the best product on the market, technically speaking. There are hiccups, continued hiccups at Medtronic in terms of issues with the new pump and the FDA, the fact that CGMs continuously just don't work very well. We think they're going to keep being a shared donor to its competitors, mainly Tandem. And third, its new products pipeline is really promising. So as we mentioned, Tandem has the best the best pump, the T-Slim X2. It's the easiest to use, thanks to its interface, thanks to Control IQ. It has the best performance in terms of time in closed loops. That time in range performance that we care about is the best in the market. And it's tied to the best CGM sensor, which is basically that glucose monitor, which is produced by Dexcom. The G6 and the G7 is going to be even better. So really, we think the narrative of Medtronic losing share and donating that primarily to Tandem is going to continue, and that's corroborated by surveys that suggest that patients are churning into Tandem and our own VAR call with endocrinologists. Now, back to Jason for the international point.
Thank you, Jeremy. So I will talk about our third thesis point regarding Tandem's potential to expand internationally. So Tandem first entered OUS markets in 2018 after taking over for distributors from Johnson & Johnson's insulin pump business line. And they really just began expanding beyond those distributors in 2020 while facing COVID pandemic headwinds. As a result, Tandem is significantly underpenetrated in OUS markets relative to its peers Medtronic and Insulet. In current OUS markets Tandem is in, there are over 4 million type 1 diabetes patients, representing a significant opportunity for Tandem moving forward. Furthermore, Tandem's Control IQ technology was just approved in some of its largest OUS markets, including Germany and France, which we believe is another catalyst for international growth. In addition, we believe there's potential for Tandem to expand into new OUS markets where it's not currently present. Per our discussion with Tandem's investment relations, Tandem's goal is to expand to all countries where Dexcom's CGM has been approved. Countries where Dexcom has been approved but where Tandem is not currently present include Turkey, Poland, India, and Japan. In our base case, we conservatively assume that Tandem does not expand to any new OUS countries over the next 5 years. However, in our bull case, we believe this expansion could lead to 15% of OUS sales. Now, my colleague Mike will talk about our margin expansion thesis and valuation.
Thanks. So if you recall from the IRR slide, the largest driver of returns is actually through operating leverage. So they're currently at 3% operating margin, and they're guiding to 25% by our exit year. And how are they going to get there? The biggest portion of their operating expenses right now is through their sales force. And they've already borne the majority of those costs when it's training and deploying these people at medical centers across the country. And those costs are fixed at this point and won't scale with volumes going up. Additionally, they have G&A leverage as they expand into peripheral countries within Europe where they have shared services already in place. So if we were to look at the unit economics, you can see that they sell them for close to $8,000 each pump for close to $8,000, and they get around $5,000 in profit from that. So from there, we calculate the fixed cost break-even is around 52,000 pumps they need to install per year to cover their fixed costs and 87,000 to cover their total operating expenses, at which point they would have incremental margins of around 60% on each pump sold beyond that point. And you can see in the chart on the right that margins have really scaled up as they've scaled up volumes as well, and we continue to see that going forward. So bringing it all together just with each of our thesis points and trying to quantify where they are with our revenue build, it's really best demonstrated through our patient build right here. So they've set what's been described as a lofty goal by the sell side of 1 million users by 2027, and our base case assumes that they're going to hit that. We came to that conclusion through a series of primary research calls we did with endocrinologists, patient organizations, and other health associations across the country. And the conclusions that we came to that were variant were the fact that the street is largely modeling peak penetration too low. We think that there's going to be a continued conversion of people from MDI or multiple daily injections onto these insulin pumps because they're just a better product and a better way to live with diabetes. Additionally, we think a lot of the street is really underappreciating Tandem's competitive positioning. We think they have the best pump on the market, and we think a lot of estimates are really understating the share gains that they can gain. So bringing it together with the valuation, from our revenue build, we apply our assumption of operating margins to arrive at our 2027 earnings figure, and then we use an exit multiple of 36 times, which is in line with their high-quality medtech peers of similar growth and margin profiles, as you can see laid out over there. So to quickly just recap some of the risks, there's always competition among insulin pump manufacturers, but what we've largely seen from Tandem is that they've got a continued ability to innovate and deliver market-leading products. Additionally, they have exposure to potential reimbursement changes through CMS, but we think that the patient demand, growing patient demand, is really going to offset and mitigate a lot of these risks. Finally, just any pipeline delays that could really offset some of the timeline of the revenue build. But again, Tandem, we would just highlight, that has a very strong track record of delivering on their pipeline. So in conclusion, we're just happy to take any questions.
So I think I agree fundamentally with the demand and superior product, et cetera. But they're competing against at least two, I think, very well capitalized or innovative competitors. What I worry about with a company, sort of a single product type business in that kind of competitive landscape, I mean, Medtronic, for example, is not excited to be going from 80% market share to 60 or whatever the number is. And so they're obviously, so why can't a competitor just make a better one? And how do I think about that risk in, owning the stock?
Yeah. So I would just say, one, to Medtronic's point of view, they are very well capitalized, obviously, but this is more of kind of a niche product within their business. So they're a conglomerate. You can think of them that way. This is about 10% of their business. So a lot of what we've gathered from speaking with patient organizations, prescribers as well, is that the product's been very neglected within Medtronic. They initially bought it. They didn't develop it in-house, their pump. And the feedback has been very mixed, that they have very hard time getting sales reps to go out. It's just typical things that you would see from a company that's not ultra-focused like a one-product company like ours. As opposed, the other alternative would be if there was another startup, say, that kind of entered the space. It's very challenging to enter the space. We can go through the patents or anything to that effect, but these have been 10 years plus in the making. It's a lot of capital to invest before you can ever, hope to get a product approved and then, eventually become profitable. So typically in these kind of med tech spaces, there's really only about 3-4 competitors or so who dominantly play in them. So we feel really well protected. One, with just the product, the innovation that we had so far, kind of the infrastructure of R&D, and two, just the fact that it's somewhat underappreciated within Medtronic, and they haven't really significantly innovated since they bought the product.
And perhaps just to add on to that, the fact that it's a closed loop, I would really stress, is very important. And the only way you achieve that is by having a CGM. Tandem's great thing is they've collaborated over 3 or 4 generations with Dexcom, who's by far the market.
But Dexcom will sell their product to anyone.
Right, but if you're a new entrant, so Medtronic
I'm
uses
less
their own.
afraid of a new entrant
Okay.
than I am of, it sounds to me, and again, I know nothing about this business, but it sounds to me that, like Medtronic, you're correct, underinvested, lack of focus. It sounds like Tandem has sort of better software, right? And, better system. It makes sense for this to be an integrated closed loop type product. Why can't Medtronic, hire some good engineers and update their product? They already have 65% market share, whatever the number is. They don't need to do a lot of selling to tell people, oh, by the way, you're an incumbent, you've been using this for a while, here's the new version of the product, and it's as good or better than the competition.
Well, 2 things to that. They tried doing that with their new pump. The FDA won't let them sell it in the US because they screwed up some of the product, basically recall issues. And then on the real reason they're losing share is because their CGM is just not very good compared to Dexcom. To give you a concrete example, if I would put a Dexcom CGM on my skin right now, in 2 hours, I just need to enter a code into the app. In 2 hours, it switches on, it gives you my first reading. 2 hours is very long. The next Dexcom G7 is 30 minutes. For Medtronic, it takes about the same time to come on live. Then it asks me to give it a reading myself. I have to fingerprint stick myself. I would have to tell it.
Why can't Medtronic just buy the...
For context, they have their own CGM and they bundle it together, so that's their strategy. So they could potentially partner with Dexcom, but they would have to, it would be a big shift for them.
They'd have to ditch their own product.
Right, which is not impossible, but I think what we've seen, kind of the moat that we see around it is that it's not as easy as just plugging and playing with a Dexcom, with a pump that's built around it. And they're, from everyone that we've talked to, the best integrated by far around that, just with regard to performance.
Just to the point on the IP, love to understand how much they're spending on innovation, and sort of if you think about their sort of technology roadmap as well, where they're heading. One thing that sort of jumped out to me was the fact that if you look at their patent filings, there really hasn't been very much since 2013. So is the strategy more about buying the IP than developing it in-house?
Yeah, so I can't comment on the IP strategy itself. I'd be lying if I knew specifically what they're trying to do. But their investments are enormous, right? That they're investing heavily in this. In terms of, and you can see that through the product pipeline, they have this ambition of creating a tubeless. It's actually a hybrid pump, so you'll be able to tube it or untube it. And so they're clearly investing. The Omnipod, which is Insulet's product, is the only tubeless product on the market right now, and that's really its moat. So they're attacking their basic competitor's moat. And And so I think if they haven't released patents, they will, because they're projecting this for full year 2024. So I don't see that as a key risk for myself.
It's definitely in-house development as opposed to external pieces, though.
So when I see companies like this, an innovative single product company that's developed something but is competing against a giant that has 2/3 market share with 20 times the market cap, Bill raises a good point. The giant can often squish the small up-and-comer. The very common strategy, particularly in medical device space, what little I understand of it is an equally deep-pocketed giant that wants to penetrate that sector, that has a monstrous sales force, established customers, et cetera. So I just Googled largest medical device companies, and after Medtronic, Stryker, Boston Scientific, Abbott, and J&J, it strikes me that one of those four, knowing nothing, would be, this is a $6 billion enterprise value here. It's a bite-sized acquisition. Did you talk to analysts? Any sense, is that a potential nice exit here?
I mean, you're right. It's very doable for a company like that. It would be an easy tuck-in. They already have the sales force and infrastructure already established. And one of the problems, not a problem, but kind of an uphill battle that they face about international expansion is that it's much more difficult for a company, $6-7 billion market cap, to build out a sales force and all the infrastructure in place when a Medtronic, the incremental costs for them are very easy to enter a new country. So yeah, to answer your question, absolutely. I think it would be an easy tuck-in for one of them. It's just, there's only so many players in this space. You'd have to worry if there's any kind of regulatory issues around that. But yeah.
Just a quick one for me. It trades at a high multiple, right? And you buy down that multiple in part by expanding margins from 6% this year to 25% your exit year, and about half of that looks like comes from gross margin. So curious, what's driving that gross margin improvement? From 54 to 65%, and then if they can't get, what are the components of cost of goods, et cetera, that let you get there? Because it sounds like a lot of their cost of goods is software and stuff. I could be wrong, and then how do you think? Related question: how do you think about downside protection? If you're a small miss on margin here in this type of market can lead to a big correction in the stock, as we've seen, in a lot of different things this year. So.
Yeah, so on the gross margin side, so they're guiding to 65%, which we think is attainable. The biggest driver of that is kind of nuanced, but they have two different models. One is selling directly. They have sales reps out there, and then they go through distributors in countries like Europe. So largely the biggest change in that is they foresee basically a shift in their sales mix, largely towards that distributor model where they get a higher gross margin on that. Somewhat cancels out in the OpEx, but it's largely kind of a sales mix change through that for the gross margin side of things. And to the multiple side of things, you're right, it does trade at a high multiple. But just to put it into context, I apologize for flipping as we're doing this. But relative to these kind of high-flying medtech companies, it's actually not that crazy. So really the only two comps in this space, Insulet, they make somewhat of a different product, and Dexcom, which makes a CGM, so it's not a direct corollary. But a lot of these companies trade on multiples of forward sales. So if you look at it, it's really not that outrageous relative to where a lot of these companies trade. For sure, in a correction environment, a lot of these growth stocks are the first ones to get hit. But we see them, we don't really necessarily see them as a company that should be trading on sales a few years out. They're going to be profitable for sure. So we think that there's definitely value there.
If you could go to page 21, where you build up your installed base, which is obviously the most critical assumption, I would say, to your revenue, which then generates the operating leverage to get you to your earnings growth. 330,000 users today, roughly tripling to 1 million. One of the things that caught my attention was the user attrition. Is about 2/3 of your current installed base and would still be close to 20% of your ultimate installed base. Could you talk about why that seems high to me, particularly given all of the things that you talked about? I would assume people, if you're on an insulin pump, you stay on it for a very long time, and this seems to be the one that you'd want to use, given everything you talked about. So just could you talk about why user attrition assumptions look relatively high?
Yeah, for sure. So they have a reimbursement. I should preface this. This is over 6 years. There's a reimbursement cycle of 4 years for the insurance company. So an insurance company will buy you a pump and expect you to use it for 4 years. So each year there's the users that joined 4 years ago that come up for resale. So and it's not really out of line with any of the other pumps on the market. They see about 25-30% attrition annually. And those people either have tried pumps, they say, the majority of them just want to go back to injecting. Some people, it's just a lifestyle preference. They don't want to wear something. We don't necessarily see as many going to alternative pumps, so jumping to a Medtronic pump or anything to that effect. But across all the pumps, it's generally around that 25 annual churn. That's just what we've seen. And at the end of the day, a lot of it, we found talking with doctors, it just comes down to patient preference. Some people want to go swimming, things that you can't necessarily do with a device on you, those types of things that kind of take people out.
I guess just maybe building onto that, and I assume this 200,000 is not on their current base, it's over a 5 or 6 year period from now, so let's call it 40, 30,000. You could still look at that as being a 10 to 15% annual churn rate. And so it seems like, we talked about the competitive dynamics of the well-capitalized people having opportunity on a product cycle, which would be forced at a 4-year period. But it also sounds like it's not necessarily the case that everybody actually, not just, obviously, if you want a pump, you want the best pump, but it doesn't even sound like everybody wants a pump. And a lot of people who have the best pump decide not to go with it. I mean, if you just take up that attrition a little higher and your competitive wins are a little lower, you can get to your downside scenario pretty quickly, which is not an attractive IRR, I would think. How do you think about bounding that user attrition, given that that could really present a very large headwind to your numbers if that were a little higher than what the company's talked about?
Yeah. I can talk again if you want. Yes. So what we've found, and we talked to, again, most of our insights came from the prescribers, and what we found from them is that a lot of these people, they try it once, maybe they don't like it, they're taken out. We don't necessarily see a lot of, and they're mostly older people who aren't as tech savvy, people who don't necessarily have a smartphone, for instance, a lot of older diabetics. A big advantage of this is that it can link up right to your smartphone, a lot of technological advantages. So a lot of those kind of older demographic people try it, come out, but what the doctors have told us is most of the people who are sticking with it are these younger people who they plan on staying long term. And it's really just a matter of getting these kind of first-time pump users to try it out. If they're not ideal candidates, kind of weeding out, but we don't really see that playing out long-term, is growing from there.
I would just add also what Jason pointed out earlier. Our base case doesn't assume any international expansion whatsoever. So I think there is some buffer there as well. You're talking about very large countries, Saudi, Japan, Korea, a lot of parts of Europe that we just haven't built in, because I think the assumptions would be hard to fetch. So I take the point, but we've also been conservative on other variants.
Yeah, just to add on to that, they also have a partnership with Abbott, which is the other large CGM maker in the market. We also did not build any assumptions into that, just because they have not had a product approved yet. We do not know how successful this would be. But we also believe this could be another potential tailwind for them.
Thank you
so much.